I mean, to what extent do you share Mike Wilson's view in terms of what's next for this bear market?
Well, good morning, Yousef. I think there is some pain ahead. It's been a tumultuous year to start with, that 11 and bit month in. We've had the S&P in that time from 48 to just under 4,000. So it's really cranking down, and I'm worried about how we move over the next couple of months with the CPI numbers coming forward and the Fed's views and the overall themes, I think, rolling into everything could be a little bit further softness.
JP Morgan has gamed out a few scenarios, and their Armageddon scenario actually doesn't see much downside, to the tune of about 10%, assuming that rates begin to moderate a little bit above 5%. Is that your worst case scenario as well?
Well, when you put your mind back to that, we're only taking our view back to October then, because we're at that sort of number, 35.77, I think was the low for the year. So, you possibly could retest that, or certainly the 37 handle. I think it's going to take a couple of months to actually get there. I feel as though that we've got a nice little uplift at the moment, and that may continue for the short term leading into Christmas. And where we go after that, hold on to your hat, because it could be a bumpy ride coming into January, February, March, that first quarter.
To what extent could the Fed begin to shift gears more aggressively? Because as the market begins to be a bit more optimistic, you're seeing financial conditions get relaxed, which is counterintuitive given what the Fed would like to achieve in terms of inflation. Could you see a more hawkish Fed going into 2023?
Well, you could do. I'm worried to see. I want to see a couple of things. What consumer confidence is over the next matter of a month, and what that's Christmas sales, and of course CPI numbers, and the view from the Fed coming out as far as, is it 50 basis points? Everyone's telling me it is, but do they crank it up and go 75? So I just gauging rhetoric, gauging sentiment, Yousef, and all of those factors really create the opportunity for traders, but also from a confidence level moving forward. So where are we? Where are we in mid-January sets us up for that first quarter, I think, and it could be a fascinating month ahead.
Yeah, we're looking here at the chart that gives the additional perspective in terms of the financial conditions index. Peter, What's the breakdown in terms of asset allocation? How do you manage positioning as we begin to wrap up 2022?
Well, I think a couple of things. First off, you've had such a big move to the downside for that US dollar, and it's just been crushed. You're looking at yields. Everyone's had a glory run on yen and pound, and certainly the euro in the last month and a bit. It's been one-way traffic, dollar crushed, and the equity markets, they've had a nice rally over the last month, and that may continue for another week or two leading into Christmas. So I think US dollar comes off a little bit further. Where we run from there, that's going to be a hard one, because it's very much a week-by-week proposition, Yousef. So much volatility, and that really creates the opportunity.
What would be considered a win for the Fed as we count down to the PPI and then later on in the month to the CPI numbers? Where's the bar, and how do you expect equities and bonds to reprice and adjust to that?
Well, if CPI comes down and we have a good read, and that's going to be a confidence factor, I think that takes a fair bit of heat out of the Fed. And if it really comes down, it's a showstopper, then that's a good mood story. And that creates, I think, a good feel across the equity markets. And everyone more or less says, well, maybe we've hit that top end, top velocity, we've crushed it, and now we're on the downward trend. So we wait patiently for those numbers, Yousef, to get a true indication how we move forward, and the confidence and the sentiment leading into that January number.
To what extent is the weaker energy price, specifically in Brent and WTI, a red herring? Because RBC is pointing to a bit of an unusual structural component to the paper market and low liquidity air pockets as the reason for why we're here. Maybe the real oil price needs to be a lot higher given where we stand with some of the key variables.
Well, yes, it could well do. I mean, I'm concerned as far as, the impact, with Russian crude and the OPEC numbers that came out last week, all of those storylines. So the first part of it, of course, is if crude continues that downdraft, and here we are with 72 and change for WTI, if it was to get into the 60s prior to the Fed talk next week, that's a good sign from an inflation story, but more importantly, from a confidence level for consumers. So that's good news. And if Brent does the same and it comes down to, that low 70 sort of number where WTI is at the moment, that's going to be, I think, build on what we've seen as far as that US dollar off, oil off. And that's a good sign for central bankers and certainly for the consumer down there all across the globe.